Hello everyone and welcome back to another video on investing on the stock market. Thanks so much for tuning in. If you like what you see, subscribe. I do some basic videos like this, but also some stock company specific ones, Tesla, Amazon, all these cool companies. So let's get down to the very basics of investing. How do you do it in a safe and responsible way? Now, before I get into my specific points, I assume that you're diversified, so you've spread your money out between different assets and different stocks. You cannot have too many eggs in one basket. This is self-explanatory. I assume you've taken on a healthy level of risk. You haven't put all your money in one stock. You haven't put your house on Bitcoin. You're somewhere in the middle where most responsible investors are. And one, you have discipline, which means you're not just going to panic and sell as soon as it goes down, okay? So you're a buy and hold investor. These are the very, very simple pillars of investing. So where are the safest places to put your money? We're going to start off with index funds and ETFs. Index funds and ETFs will give you the ultimate form of diversification. You put your money in them and your money is spread out between hundreds, maybe thousands of businesses. The chance of all of these businesses going out of business is zero. And in the long run, you'll never lose money. Statistically, there's a 0% chance. I recommend the US, but you can go with Europe, global, Asia, whatever you feel like. Because the stock market goes up 2/3 of the time. And even when it goes down less than when it goes up, at least in percentages. And over the long run, you'll make somewhere between 6 and 10% on the stock market, depending on where you invest and your risk level. And over a 10-year period, a decade, if you bought the Dow Jones Industrial Average or the S&P 500, which are US indices, the chance of losing money is zero. We've never had a decade in the red. So think about that whenever stuff goes wrong. Don't sell, just hold on to it in index funds. The next place would be dividend paying blue chip stocks. So take your big all-American company, at least 40 years old. They're paying a dividend. The stock is really stable. They're not really growing that much, most of these blue chip companies. Blue chip companies are these massive companies, the biggest of the biggest, and a lot of them have stagnated. And instead of showing massive growth and price appreciation to investors, they play nice by paying out a dividend. So you get a safe stock, a safe company, and a dividend on top. And dividend is a way to reduce risk because it's a cash payout you get 4 times a year usually, no matter what happens. Dividend can go up or down at any point, but it's always paid on time, and in 80% of the cases, the dividend is increased over time. And over the last 25 or 30 years, since 1980, 1985, almost 2/3, so almost 60% of the gains in the S&P 500 in the US has come from dividend. So it's not always going to be the case, but over the long run, dividend can give you more money than the actual stock price going up. So you can't really go wrong with this strategy. Next up is going to be a bit of a general term, defensive stocks. Defensive stocks are companies not depending on growth. They're not dependent on a roaring economy or high or low interest rates. They're just chugging along. And I'm going to use an example of the safest company that I know of, okay, which is waste management. So waste management, I'll just use this example, is a big company with a very simple business model. They pick up trash. Trash is never going anywhere. The trash is in the US, so whatever happens in Europe, China, whatever, doesn't affect them. No matter what happens, if a recession comes, if interest rates go up or down, people are going to still throw trash. Someone's going to pick it up. Someone's going to recycle it, right? Their money comes from cities, states, big corporations, big building blocks, apartment complexes, and their money is not going away. And if no one picks up trash, no one wants to live in these areas. So it's pretty much the number one thing you have to do if you own a place, is to keep it clean. The stock has shown an incredibly stable path. Dividend going up every year. No major scandals, no bad news. They're just trucking along. Nothing is happening. So if you got the idea, this is a defensive stock. I can't give you too many examples because I don't want to show you some stock and say this one is really safe. But then poof, it just suddenly collapses. There's some really bad news. It gets hit by a lawsuit or recession, and it just goes down the drain. But this is one that I'm comfortable recommending, or at least mentioning as a safe stock. And then we're on to bonds and passive income ETFs. These are the guaranteed cash flow alternatives. Bonds and income funds are funds where you put your money in and you get a set percentage of money every year. Some of them, the income funds, are as high as 10% every year. So you get 1%, almost 1% every month. And the price doesn't really fluctuate, it stays the same. Bonds, we all know bonds. You borrow money to the government and they give you a set interest rate. It's usually between 2 and 3% when you go into a bond ETF. That's going to be the dividend, and then you can get some price appreciation on top if bond yields go up or whatever. So bonds and passive income, if you're really scared and you just want a part of your portfolio you can feel really safe about, you could go with one of these. Now, one thing that I'll add that I didn't have on my list initially are commodities, precious metals, any sort of raw material. You can buy water fund, coffee fund, gold, silver, platinum, probably obsidian, steel, corn, I don't know, avocados, whatever you want to buy, there's a fund for it. So if there's some sort of commodity that stays really stable price-wise, or is always going to be needed in production or used as a form of currency like gold or silver, you can go with this. So it's sort of like a hedge as well to the stock market and to foreign exchange and Bitcoin and all these things. The last one would be value stocks and simply buying low. So the lower you buy, and when you find if you find companies which are undervalued, their valuations are really low without any real reason for it, or there's this great company that all of a sudden goes down and you buy down there, the downside risk is significantly lower. While if you buy a high-flying growth stock, some companies simply relying on big numbers and really surprising Wall Street to the upside, you can buy an underdog or a beaten dog that no one's really looking that hard at. And even if they do okay, no one's really going to notice because people have just left this company and forgotten about it. Probably not going anywhere, but again, the lower the company has gone, the less likely it's going to keep going down. So, be careful about buying low and finding these value deals. I feel like value investments tend just to be bad investments, and value companies and value stocks just tends to be beaten down companies, and they're beaten down for a reason. So if you're going for value, if you're going to buy low, make sure it's a great business, a healthy growing business, not a declining dinosaur from 1970 closing all their stores. Okay, so there's a balance here, but dollar cost averaging and finding value stocks definitely lowers your risk profile. So these are what I came up with. Most safe investments fall under as one or more of these categories. Let me know what you think about risk. How do you control it? How much risk do you like? What's too much? What's too little? I'm probably somewhere at the higher end. I have only individual stocks. They're all pretty much growth stocks, apart from Boeing, and then I own some Bitcoin. So I'm very high on the risk level, 5 out of 5, but I'm comfortable there, and it's important that you are comfortable at the risk level you're at. So that's it. Hope you enjoyed. Subscribe for more. Drop me comments. I try to answer all comments. I've been really poor at that lately, but I'll try to get back at it. Thanks for watching. I'll see you guys in my next video.